Welcome to our YouTube live session. And so this is the first one we've had for a while. We have them every month now. So welcome. And we're going to have an hour together. And let me just start off by, I think I could recap what's happened over the last month. Obviously, it's been a tumultuous start to the year. Equities sold off. We're almost in a bear market for the S&P. It's kind of flirting with it. Not quite got there, not quite 20% below the peak, but very close. And, in May, we had the sell-off, then a bounce on May the 19th. And now, we've kind of bounced back a bit, about 7%. And the question on everyone's lips is this a bear market rally? Is this just a kind of temporary reprieve on the way to lower levels?
Ramin, you're not on full stream.
Oh, no. Okay. Let me try that again. Right. Yeah. So, in terms of what's going on in markets at the moment, a bit of a bounce in May, but, is this a kind of temporary reprieve before we get back to, a rally that we saw so strongly over the last couple of years? Or is this just a kind of temporary blip and then markets are going to carry on going down? That's a real question that people are asking. So that's the video I'm going to talk about. Well, that's what I'm going to talk about in the video this Saturday. I won't spoil the punchline, but frankly, I think the whole thing about, whether we're in a bear market rally is not particularly helpful. And I think there's a much better way of thinking about markets, which is much better for investors in a practical sense. So that's what we're going to talk about in the video that's going to be released on Saturday. And the podcast for this week with Michael this one's about, it's a little bit technical, I'd say. It's to do with what is risk. So, how do you measure it? What does it mean? Why does it matter? How can you reduce it? How can you control it? Because I think the big difference between professional investors and amateur investors is their approach to risk. Amateurs generally don't really care about risk, or at least don't try to measure it, whereas professionals don't have a choice because usually they have a risk department which is standing over them with a stick to ensure they have good principles and good practices when it comes to risk. And at investment banks, you can lose your job if you take too much risk on the desk. So I think understanding risk is really what sets apart very good investors from kind of amateur investors. So the outcomes, I think, usually are better if you do have a go at controlling risk. No more treats, mate. No more treats. That's it. No more. Sorry. Oh, he's so demanding. Right. So let me just turn to the questions. Do like our channel, like our stream, and you can subscribe. And of course, if you are a supporter on YouTube, we'll answer your question first. If you do a super chat, then we'll answer your question first. And Laura's got this kind of Google document, which I'm monitoring to ensure that I know when you've done a super chat or if you're one of our supporters on YouTube, because you get a little crown next to your name so we can see very easily that you are one of our YouTube supporters. So if you do want to, become a supporter, it's very easy. You can actually do it by clicking on join, which is underneath the streaming window on YouTube if you're doing it on a PC or on a Mac. Right, so none of those yet. So I'll go back to your questions. And what have we got? So there's a question from Rob. Interesting question. Who says, at what point and based on what specific thresholds would you change your drip feeding approach to go all in? Would you still mainly buy a global equity fund to go all in? Thanks. Well, one of the things that I talk about is my market crash shopping list, and that'll be triggered in part by valuations going lower. Now, the reason why I have that portfolio is simply to reframe these market crashes as buying opportunities. Because if you think, well, markets are down, I'm not going to panic and sell. I'm excited because I think, oh, that thing that I wanted to buy, Scottish Mortgage, Big Box, or a high yield fund, they're really cheap now. So I can actually monitor them and I can say, oh, it's not quite low enough yet, but when it is, I'm going to do something. And instead of worrying about selling my existing assets, my equity and my core portfolio, I'm kind of excited about the sell-off. So that's why I keep the market crash shopping list. Partially, certainly the equity components of that will be based on global valuations. And by global, I mean principally for the US. Partly because it's so easy to monitor, the data is much more easily available, but also because it's such a dominant market. And when it goes down, everyone gets dragged down. So valuations in the US, I think, are key. And that's the one I principally measure. And I look at a variety of measures. So I look at cyclically adjusted price to earnings ratio. That's Robert Shiller's ratio. And if we look at that one right now, it's kind of expensive. The US equity market's expensive. And then remember the one which was called the excess cape yield, that adjusts for interest rates. Now, when interest rates are low, that pushes valuations up. So the fair valuations are reasonably higher, justifiably higher, when interest rates are very close to their zero lower bound, or even negative in real rates. But what we saw this year is a massive and really rapid increase in real rates, as all the world's central banks effectively at the same time have talked about tightening policy and raising interest rates. So as that happens, the price to earnings multiple, which is compatible with that, fell rapidly. And so if you do adjust for real rates, in fact, equity looks pretty expensive at the moment. If you look at the excess cape yield, which is Robert Shiller's other measure. And so, so excess cape yield, cape, both of those are signaling the US is pretty expensive. And then if you look at the forward price to earnings ratio, we're at roughly the 10-year average for that. And that looks at the forward forecast earnings for the S&P 500. So it factors in all the latest information on a bottom-up basis from all the single stocks in the S&P. So that measure also looks, not egregiously expensive, just quite expensive. We're still not at the 15-year, the 50-year or 60-year average, which is a 15 times forward multiple. So overall, it's still not looking cheap in the US. The UK is looking pretty cheap, but I think there's still some bad economic news in store there, which might make things a bit more tricky. But overall, I think equity at the moment is not at the point where I'd go, oh my goodness, I'm going to go all in. It's not even at fair value if you look at the long-term multiple, which is 15 times. It's certainly looking better than it did, and I'm much more happy drip feeding in this kind of environment. And that's carried on, right? I'm still drip feeding to my strategic weights, and I have been for about 9 months now. But where would I go all in? Well, 15 times would be the point at which I'd start to think, oh yeah, this is kind of looking reasonably priced and it's looking like almost a bargain. And if it gets down to 13 times, that's where we were. That's where we were just after the March 2020 sell-off. That was the bottom point for forward price to earnings. Again, that would be another point at which I'd think, okay, now's a good time. But we're still not there, to answer your question, Rob. And what would I buy? Yeah, I mean, in my fund portfolio, I've got a kind of quality fund I've been thinking about. And there's also some other equity funds which I've been thinking about. So Scottish Mortgage, for example, when global equity is looking really despondent, that's probably a good time to buy Scottish Mortgage, because that obviously is levered and it's very high beta. It's very sensitive to the global markets. So if global markets go up a bit, Scottish Mortgage goes up a lot. And if global markets go down a bit, then Scottish Mortgage goes down a lot. So a high beta thing is what you want in a recovery. So, I still think Scottish Mortgage may have a bit more pain ahead, but it has bounced recently. It's up about 18% since its low in May. So that's another thing I'd consider. But all the stuff in the shopping list probably would be affected by this. Plus, I think there's more pain to come with the credit market. I still think that hasn't really fully priced in what's going on with zombie companies in America, given the higher level of interest rates and the widening credit spreads. It's going to be harder to roll over debt, and I think the default rates may start to pick up. And then you get this kind of cycle of downgrades and defaults, which we're all very familiar with, and it's not a pleasant experience by any means. But still, I think high yield credit is another thing I'm thinking about. That's certainly on my shopping list. And I'm monitoring those spreads and yields for high yield credit pretty closely on an almost daily basis now. So yeah, that's what I'm thinking about, Rob. Very long answer to your question, I'm sorry. Okay. Let's see if we've got any members. Oh yes, we do. Okay, super chat from ChenMD411. Okay. Whenever I see 411, I always think, was that 420? Because I know what 420 means now, because I Googled it, because I'm old. Right, so 411 I'm not sure about. Who says, would oil selling off indicate a market bottom? Oh, interesting. The thing is, the things that would make oil fall would be a lack of demand. So certainly China's helped to reduce the upward pressure on the price of oil, because if it's locked down a large proportion of its cities, some of them are now coming out of lockdown. Some of the large, tier 1 cities have come out of lockdown. So that's kind of reversed partially. So if the demand falls, then that might be a negative, because China clearly, if it's locked down its big cities, and China has a very low GDP growth this year, that's going to be a negative shock to markets, and that'll be a negative for global equity. If it's because the supply's increased, it probably means that Russia's lack of supply has been either counteracted by an increased supply from the rest of OPEC, which was announced today, or maybe the hostilities have kind of dialed back between Russia and Ukraine, or maybe even be resolved. There could even be a ceasefire. So it really depends on the reason why oil prices fell. If it was a ceasefire in Ukraine, then that would be a big positive, because geopolitical instability has been a big fear driver, and it could cause some real problems with food supply across a lot of Africa and the Middle East in the not too distant future. I mean, it's already getting to the point at which it's getting too late to ship out the grain harvest from Ukraine. And if that happens, a lot of countries are going to go hungry, and that means political instability and a repeat of the Arab Spring. So really, I think it depends on the problem which triggers the fall in the price of oil. Is it lack of demand? Is it increasing supply? And why has the supply increased? Is it because Russia's come back online, or is it because Russia has simply been sidestepped from other OPEC and oil producers dialing up their supply? So would it indicate a market bottom? It would certainly help, I think, because if the price of oil comes down, inflation would also come down. Because if you look at US inflation, a 70% year-on-year increase in fuel oil is crazy, right? So if oil prices came down, then eventually gasoline prices would, and that would push inflation in the opposite direction that it's been pushing it over the last 5-6 months. And that would be disinflationary, and that would be seen by markets. Equity markets is a big reason to surge. So really, I think it depends on the cause, and also the effect it has on inflation and how long it takes to feed through into lower inflation numbers. Because certainly I think if inflation comes off 8% down even to 4 or 3 or 4%, markets could tear upwards. It would be quite reasonable for them to do that, because that was a big worry. And of course the Fed would also probably not be so aggressive, and that would also be good for equity. So oil is so important because it affects all of these variables. It's like the one thing that feeds into everything. So it's a pity it's almost unforecastable. But yeah, I think oil selling off would be good news on the whole. Right, next super chat is BUB, who says, what are the most reliable types of payments, please? I wonder what you mean by that. Reliable types of payments. Do you mean dividends? What are the most reliable types of dividend payments, maybe? I mean, if you're buying dividend stocks, remember the style that's worked best so far this year has been high dividend stocks. So if you want to buy high dividend, you can look at companies which have a high dividend cover, which means that if you look at their free cash flow, they can cover the dividend payments they make multiple times over. So high dividend cover stocks which pay a high dividend, which is growing, those would be good stocks to buy if you want a reliable set of payments. Oh, I think Laura's typing a follow-up. Yes, she says. Yes, he confirmed. He does mean that. Okay. So, yeah, reliable dividend payers. The other thing to think about BUB is, and thank you for the super chat, by the way. We appreciate it. And the other point is that what you want is sectors which are likely to be able to maintain their margins. The reason why we've had such big sell-offs in companies like Target, Walmart, Amazon is because their input costs have increased, and that's reduced their margins, which has been so shocking that it's given them such big falls, intraday falls, that it hasn't been such a large one-day fall since 1987. The market was totally shocked by it. But really, I don't think the market should have been shocked, because if inflation is running at above 8%, well, what do you think is going to happen to margins? At a certain point, companies can't pass on these higher costs to their customers, and their margins have to drop and their profits have to fall. And it's still the case that very few sectors are seeing their forecast earnings being downgraded. They're still expecting year-on-year increases in every sector for the S&P, pretty much. So, if you do have to choose a sector that's most reliable in terms of dividends, try to find the ones which won't be negatively impacted so heavily by rising input costs. So anything which is like an IT company has energy costs for things like servers, but it's not a big driver. Whereas a company which requires transportation and shipping, those costs will increase because of the fuel costs. So any kind of sector where fuel costs are an input cost is a problem. Energy, on the other hand, not so much, right? Because energy companies are going to have, a high oil price is going to help them a lot. So there's a reason why the energy sector has done so well this year, and that's the high price of energy. And they can maintain high dividends probably very easily. So yeah, that's the kind of sector I'd go for. Ones where energy is not an input cost and where you wouldn't expect margins to suffer in the near term. So, keep your eye on those margins. Look at the FactSet earnings report from John Butters, the one he publishes on a Friday evening. And he talks about the single sectors and the earnings upgrades and downgrades, and you'll see which sectors have gone up or down. So that'll give you a steer as to which sectors are likely to benefit. And if you do go down the single stock route, I choose from the sectors where the dividend cover's strong, and for the companies where dividend cover's strong and they've got pretty good margin control. And a monopoly would help there, right? If it's a monopoly, then they don't have competitors that can squeeze down their margins. So that's probably how I'd approach it. Okay. So don't forget, like us, even if you're watching the replay, like us and tell your friends about us. And also, don't forget to subscribe, if you aren't already subscribed. And listen to our podcast, which seems to be going down very well with people. Right, next question is swig Fanta. Oh dear. So Alice is saying, what's your outlook for sterling versus the dollar in the coming year or so? Yeah, well, you know what they say about economists. Economics is there to make astrologers look good. Well, FX strategists are there to make economist forecasts look good. Because with currency, certainly over a 1 year period, or even longer, right? It's almost impossible to forecast what's going to happen to currency rates. Clearly, sterling's taken a drubbing against the dollar and against other major currencies, and it's because of growth. It's because growth is poor. It's because the UK central bank is unlikely to be able to hike as aggressively as the Fed say, probably. I think the understanding is that growth here will be weaker. Inflation may be less of a problem, although they're still forecasting inflation above 10%. But I think stagflation is assumed to be much more likely for the UK compared to the US. Growth there is perceived to be better, I think. And that's expressed in long-term yields. They're higher in the US. So really it depends on what happens to rates in the UK and what the central bank does here. I mean, the Fed was moved after the Bank of England, which is really unusual this time around for the first hike. But if anybody has to step back, I suspect it might be the Bank of England. And it's because partly the UK, a large proportion of UK wealth, half of it, in fact, is with housing. And if lots of people have got a lot of leverage, which they financed when interest rates were at zero, chances are that that's what they did. And if they've taken too much leverage and the Bank of England raises interest rates, it doesn't want to see a situation where we just have defaults left, right and centre, everybody having their houses repossessed. That's just not a good look for financial stability. And there'd also be a wealth effect. If people are being thrown out of their houses, then it would have a knock-on on consumption and people would be less likely to consume probably. So there would be kind of secondary effects on corporate earnings as well. So I think the Bank of England can't really move aggressively, at least not as aggressively as the United States. That's probably why sterling's been weak. And I can't really see a reason in the near future why that would turn around, why the UK growth would suddenly be seen to outperform the US, which would push up UK yields and strengthen sterling versus the dollar. I think that looks unlikely. It's possible, but I'd say it's unlikely. But you can see why I'd never make a forecast of any kind of currency or oil or any of these things. I took a stab at house prices based on price to income ratios and earnings growth, just simply extrapolating those two variables using a very simple time series model. But for currency, I wouldn't even try, right? I'm sorry I can't answer that, Alice. But, it's difficult for us as well because Laura has to convert some of our US earnings for PensionCraft to sterling. So, she has to use her own judgment to see when that's going to happen. She says she uses Laura's waters, right? She feels in her waters when sterling is going to strengthen or weaken. So that's her forecasting method. I'm not sure that's very reliable, but she tells me it is. But that's probably good as any FX strategist in Wall Street. So there we go. Next question is from one of our supporters on YouTube, who is Stephen J. Nice to see you again, Stephen. And he says, if another Arab Spring happens, what is the ETF to be in? I'm guessing oil, commodities, and then when credit spreads widen, buying high yield bonds. Yeah, that's a pretty good take, I'd say. Remember that the reason why he's saying that oil would be a good play is because the Middle East obviously produces a lot of oil. And if there is political instability in the Middle East, then there'd be a question of whether supply would be reduced. And if that was the case, then oil would take another leg higher. Commodities, general commodities probably not, but oil certainly. I think that's a good play. We can't really short some of these single countries. But certainly once the sell-off happens, then you could use that in order to buy other things which could be depressed in price. So something which could be related would be emerging market stocks. So it could be that the whole of emerging markets sell off because of what's happening in North Africa and the Middle East, which does make sense rationally, but people just panic and say, EM is something I don't want right now because I'm scared. But that could be an opportunity for you to pick up, say, emerging markets in the Far East, Vietnam, Philippines, or whatever. So there could be some single country opportunities which get downgraded in people's minds, but in practice they're still okay. That might be one approach as well. But it's pretty hard to play it as a retail investor like us, unless you can go short. But I think your idea is pretty good. And high yield bonds, yeah, emerging market debt, that would sell off hugely if there was another Arab Spring. And if the yields for that go up again, to 7, 8, 9%, 10%, that would be a buying opportunity as well. But, that's a market which is looking pretty shaky at the moment. Emerging market debt, because of the default of Russia, which has just happened, a kind of technical default. And, Sri Lanka is and other countries that just defaulted on its sovereign debt. I suspect there'll be more of those. That's usually what happens when the Fed aggressively hikes. There's often problems in emerging markets, particularly emerging market debt. So, yeah, that might be another way to play it. Good question. Interesting. Next question is a super chat. Thank you, M. Ahmed. Oh, very generous. £5. Thank you. And he says, why hasn't the UK-based Vanguard US equity fund, so that would be VUSA, I think, not dropped as much as its Vanguard US-based counterpart, VTSAX? Well, I guess the UK one might be denominated in sterling. But if that's the case, what I would have expected is that it would have fallen. So if sterling has weakened versus the dollar, yeah, I'd expect it would have fallen less, because the sterling weakening would have actually flattered the returns for the US fund. I don't know whether the UK one is quoted in dollars or sterling. But really, I mean, if they're tracking the same thing, the returns should be similar. The only difference between the two will be currency. So whatever the difference is, that's where you should look. But what I would have expected is that the UK one, yeah. Okay, so if sterling has weakened versus the dollar, that would mean the UK one, quoted in sterling, wouldn't have weakened as much. And this is, a general thing, right? When you think your currency is weakening, you buy foreign stocks before that happens. Okay. If you think your currency is about to weaken, you buy foreign stocks, because when you convert them back to your domestic currency, it converts into more of your currency. If you think your domestic currency is about to strengthen, then your foreign non-domestic currency holdings will suffer. So that's the way to think about it. But that's why the two are different. That's the only reason. Unless it's tracking a different index, which I suspect it isn't. I suspect both of them track probably the S&P. Certainly VUSA, which is the UK version, is tracking the S&P 500. And if I have a quick look at VTSAX, that is tracking. Will it tell me? Overview. That's what I want. It's tracking the entire US equity market. Okay, so not the S&P. It's also got a tilt to small caps, which have performed very badly since the beginning of this year. So that might be another reason. A small cap tilt would have suffered this year, whereas VUSA is market cap weighted. So that could be another reason. Anyway, good question. Thank you. And thank you for the super chat, M. Ahmed. Brilliant. So back to your other questions. Don't forget to like us and to subscribe. And the next question's from Tim M, who says, hi Ramin, does gold have positive returns in stagflationary environments? If so, how high could it go based on historic precedents of stagflation? Yeah, I mean, gold in stagflationary environments is pretty much the only asset which does pretty well, because when you've got stagflation, I mean, as a kind of hedge for inflation, gold is not typically very good. But if interest rates are very high, then gold usually suffers. So, that's the kind of thing that pushes in the opposite direction. Dollar strength as well, bad for gold. So really it depends on those factors. What's real interest rates? What are real interest rates in the US? How strong is the dollar at the moment? Very strong. Both of those are negatives for gold at the moment. But stagflation generally is good for gold. And primarily you'd look at the US to see whether it's in a state of stagflation. Now, the UK is much more likely to be in a state of stagflation, but the UK is such a small player in the global economy, but also in markets, that it's much less relevant. That's why all eyes are basically on the US in terms of stagflation. Are they going to have stagflation? I think it's unlikely. I think inflation, growth will be okay, probably. We might get a short, shallow recession, but the consensus is that that's going to be what happens in the UK. Q2 and Q3 this year, people are expecting a kind of shallow dip into recession for the UK. But I think generally people expect growth to be weaker in the UK than they do for the US. So is that a great outlook for gold? Not really, because real interest rates are higher, which is bad for gold. The dollar's strong, which is bad for gold because it's priced in dollars. But yeah, if you're going to have stagflation in the US, gold is pretty good. In terms of what actual return it gives, we do have a model for our members which gives you the fair price of gold based on those variables. And at the moment, it's looking pretty cheap, relative to that fundamental pricing, even with real interest rates quite a lot higher. So I think the fair price of gold, if those two variables are good predictors, which they usually are, then, it is a bit cheap at the moment. But anyway, for members, you can sign up for us on PensionCraft.com, become a member. You get access to that gold pricing model. It's very simple. I wouldn't put too much store by it, but it is quite useful, I think, just as a crude idea of what the fair price should be. But I don't have that on me. I don't know exactly what the numbers are, and I haven't updated it this week. So anyway, there we go. Let me just have a look. Laura's spreadsheet. Oh, we've got another question, and this is Talbot Sunbeamer, who is one of our supporters on YouTube. Thank you for being a supporter, Talbot Sunbeamer. And he says, what prompts strong bear market rallies, considering general consensus is that the markets will fall? Thanks in advance. Okay. I think what happens is it really depends on faith, right? You remember Tinkerbell, right? Tinkerbell in Peter Pan. I remember when I was a little kid, I loved that movie. And I was there clapping my hands when Tinkerbell was dying. All the kids in the movie theatre were all clapping their hands because they didn't want Tinkerbell to die, right? Because you've got to have faith that she'll live. And it's kind of like that, right? There are enough people willing to clap for Tinkerbell right now that markets are going to see a rally. People are still conditioned to buy the dip. A lot of the retail investors, if you look at the flows, have taken money out of the market. Call options, those were really popular during the euphoric phase. Those have fallen a lot, but people still believe that markets rally because they have for the last decade. And even after the pandemic, we saw this very rapid fall and rise in equity markets. There was no real sell-off at all that was long lasting. So people are still conditioned after that decade of rallies to think markets will bounce back. There still isn't capitulation, as people say. So I think while people are willing to clap for Tinkerbell, and there are lots of clappers out there, then I think that's why we're seeing these bounces. But that's what generates the euphoria. Interestingly, in Saturday's video, I actually looked at the stats for those bear markets. And in 1973, when we had the last oil shock, there weren't really very big rallies on the way down to the bottom of the bear market. But in 2000, after the huge euphoria of the dot-com bubble, there were huge rallies, really big rallies. Same in 1929, after the big Black Tuesday sell-off in October 21st, was it? 1929. There was a huge rally of about 48% over a space of 5 months. And then markets swooned and they started falling again because people were euphoric. There was still people who remembered the euphoria, the good times, and they were still willing to buy based on that conditioning. But then at a certain point, people capitulate and they say, oh no, it's not going to work. So what I'd look for is fundamental support for the rally. High earnings growth, falling inflation, substantively falling inflation, material fall downwards in inflation, a Federal Reserve which isn't so aggressive, which would go with that. There are lots of factors. Maybe Ukraine ceasefire, or some kind of semi-amicable resolution of what's going on in Ukraine. All of these would be positive factors which could cause a reasonable rally, which would have legs. But I think at the moment, I think this is a bear market rally. But, nobody really knows. And as I say, I think that's not a particularly useful idea anyway. I think it's much better to use something else, which I'm not going to tell you. You have to wait till Saturday. Laura told me not to give the game away, right? So I'm just doing what I'm told. Brilliant. So good question. I kind of agree that I think, markets could fall further because valuations are still pretty high and earnings are likely to suffer because of high margins falling, because of high inflation. So I still don't think that's priced in. And then there's this credit story, which is likely to play out, which again won't be pretty. Right, back to your other people's questions. How are we doing? We've got 20 minutes. Here we go. Oh, this is a good one. So Anna, interesting question. She says, how does VIX work? What are the inputs for its calculation? Would you ever find trading on the VIX index a good idea or only for institutions? Oh, what a brilliant question. So if people aren't aware, the VIX index is, let's have a look at it actually. Let me just find it. VIX, and I'll share my screen. And so you can see it. Here we go. So here's VIX. And so you can see that it's very spiky, right? So a lot of the time it's kind of low, and at the moment it's kind of high-ish, but not very. When there's a big equity market crash, it spikes. So here's March 2020. It went up to about 83. So you can see why they call it the fear index. When there's fear in equity markets and a big sell-off, as there was in 2008, 2009, VIX spikes. And then as markets return to normal, volatility falls again and things return to normal. And normal usually means a level of around 16 for VIX, maybe 16 to 20. So the sell-off that we've had recently hasn't really been a high vol sell-off. It hasn't been kind of accompanied by a lot of fear, which again kind of worries me because I think, well, why aren't people more concerned? But I think if there was a sharp sell-off and some kind of market shock, then, this would spike. So how's it calculated? Well, the way it actually works is there's actually a giant portfolio of out of the money options. So what you do is you look at the single stock options for the S&P because that's how it calculates it. And then you look at all the call options, which are deeply out of the money, all of the deeply out of the money put options. And then it's a combination of those volatilities which are actually factored into the calculation of VIX. And of course, with an option, the way you price an option is with something called implied volatility. So you take the implied volatility of those out of the money put options and call options on the VIX, on the S&P. You combine them using a special formula which weights them in a specific way. And then that weighted average becomes VIX. And because they're out of the money options, usually market makers add a little bit of extra volatility to the price because they're out of the money, because those teeny options can blow up. And so to cover themselves, the option market makers increase the price a little bit to cover their arse just in case there's a blow up, right? So those teenies are quite toxic as a market maker. So that tends to push up VIX relative to realized volatility. So if you work out the actual volatility on the S&P, usually that's a little bit less than the actual VIX index because of that out of the money options which are used to calculate it. But that's how it works. You can actually look on the SIBO website, SIBO's Chicago Board Options Exchange, and there's a really beautiful document which explains how to calculate it. And I think there's a really good paper by Derman, who's the quant who explained absolutely beautifully how it's calculated. It's just really elegant, his description. So if you do have that kind of inclination, if you are that way inclined, then have a look at Derman's paper because it's really good. But that's roughly how you calculate it. But that document from SIBO also, if you want to practically calculate it, that's how you do it. Interesting question. Right. And next question is, how are we doing? We've got 15 minutes, 17 minutes. Okay. There's a question from Jay. What was your momentum strategy to identify a Bitcoin bottom based on? I.e., were you planning to look at, what were you looking to figure that out? Well, okay. So what I actually did was to look at the volatility, look at the momentum of Bitcoin itself, just as a guide to when to get into cryptocurrency. So I didn't actually buy and sell Bitcoin itself. I just used Bitcoin as a risk measure, if you like, for crypto, or kind of sentiment indicator. So I had a certain look back period, which I'd optimized based on some back tests. And then if it was triggering a certain threshold for momentum, so Bitcoin was saying, yeah, crypto's great again, then I'd pile into other cryptocurrencies, usually smaller ones where the momentum was greatest. And that had a different period associated with it. So that's how my momentum strategy worked. It was like a dual momentum strategy. And yeah, that did okay for 1 week. Then it did really bad for another week. So I ended up roughly where I started, maybe a bit below. And currently it's stopped out, right? So I haven't touched cryptocurrency for a while now because of the awful return. But that's what it was based on. Next question is from BMBM365. He says, Royal Mail, ITV and Centrica, when in the FTSE 100, are always seen as overvalued. When in the FTSE 250, they are seen as undervalued. Is there an easy play to profit from the constant index movements? So I guess what you're talking about there is, if they're downgraded from the FTSE 100 to the FTSE 250, they go from the smallest of the big ones to the biggest of the small ones. And so what you're saying is that when they get relegated, they're undervalued, like fallen angels in credit. Yeah, I mean, you could take a bet on whether they're going to get relegated and then pushed back into the FTSE 100. I guess what also matters is how much money is indexed against the FTSE 100 and the FTSE 250. My guess would be that more is indexed against the FTSE 100. The reason why that matters is because if a lot of money is indexed against the FTSE 100, not much is indexed against the 250. If something like, let's use one of your examples, Royal Mail gets downgraded from the FTSE 100 to the 250, there's going to be net selling because there'll be less money following it. So that'll be a negative. So whatever the effect on valuation is, I suspect what matters more is how much money is tracking those two indexes. So that's probably what I look at. And my guess would be that it being relegated would be a negative for the stock. So what you could do is look at the kind of most likely to be relegated FTSE 100 stocks, and you can't really short them. So you could do it the other way around. Look at the ones which have been relegated to the 250 and which you think might bounce back, and buy those because you can go long. you can buy the stock. That might be a strategy, but I mean, it's all guesswork. And frankly, that should be your fund portfolio because you'll probably get it wrong. Let's be honest. I mean, the more elaborate the schemes you've got for buying stocks, the less likely they are to work, right? I think. But yeah, I mean, for your core portfolio, just buy equity and leave it, But it sounds like a kind of fun exercise. I mean, that's the kind of crazy thing I'd like to do in my fund portfolio. So interesting idea, BMBM 365. And next question. Oh, good setup. Joe B. Hi, Ramin. Could you publish a video explaining in detail what PensionCraft offers for members? Or perhaps a free trial? Okay. Well, we don't charge that much at all anyway. And, you can join for a month and that's it. You don't have to stay longer than a month, although most people choose to, which, I'm always grateful for. But, if you do want to have a play with it, just look on PensionCraft.com, get a month's membership and see if you like it. That's what I'd say. But what does it offer? Well, I think Slack offers a lot because there are lots of like-minded people on there who'll keep you on the kind of straight and narrow. So there's kind of accountability, but also a kind of shared outlook on equity and investing and asset allocation. So if you do want to stay on the wagon when equity markets are selling off and you're panicking, then that accountability would be kind of useful. So I think Slack's useful for that. Plus there's lots of members only videos. So every week I make a new video, and I've been doing that for 3 years, where members vote on a topic and I create a specific video answering the most popular question. And people vote on each other's questions, kind of like we do on here. And if a question's popular, the most popular one is the one I make a video for. So by definition, those are things which are interesting to most people. So almost always, if someone asks me a question, there's now a video I made about it, like 2019 or whatever. So it's useful from that point of view. It's kind of library of knowledge. So, that's another thing which I think is useful. So yeah, I think those are the kind of primary benefits. And, but try it out. I'd say, have a go. You don't have to stick with us, but I hope you do. Okay. Next question is from a supporter. Thank you, Adrian. And Adrian's been a supporter for some time. I can tell from the colour of his crown, right? He says, how can we calculate the strike and quantity of put options for a given time frame to protect our shares from downside 1-for-1? Well, firstly, you have to understand the two things, I think. There are two things I think you have to know about. The first one is that when you buy an option, it's not for one stock. It's usually for, maybe 100 stocks. So that immediately creates 100 times multiplier. But then the other number you have to look at is the delta of the option. What's delta? Well, the way delta works is it gives you the kind of sensitivity to stock price movements for the option's price. So let's say you've got a 50 delta option. What that means is that for every 1% the stock price moves up or down, the price of the option moves up or down by half of that, so 0.5%. So in order to hedge perfectly, you'd need two put options to hedge 100 stocks. Okay, so you have to consider the delta. So you look at delta times 100. So in this case, it would be 50. So you'd need, if you had 50 stocks, you'd use one 50 delta put option to hedge it. So that's the way it works. What's the delta? You can get that from an options calculator. What's the multiplier? It's 100. Multiply the two together, and that's a ratio of stock to options which you need, right? So that's how it works. But usually it's not worth buying the options to hedge the equity because, you pay so much in premium, particularly once volatility picks up, because insurance prices go up after there's a disaster. And that's when people often buy insurance, and puts are the same, right? Usually you have to roll the thing as well because it's got a fixed maturity date, and once it expires, you've got to buy another one. So most of the time it's best just to kind of ignore the volatility and just, leave it and leave the equity, and it'll recover, But if it's single stocks, yeah, I can see you might be nervous, but generally put options, yeah, I mean, you can buy them, but I'm not convinced it's a good idea. Much better is just simply to, get a diversified portfolio and just stick with it. That's usually much better because the premium usually eats away a lot of the gains that you get long term. Right, next question. A good question though. I love that one. Thank you, Adrian. Next question is, we've got 9 minutes. Ooh, interesting. Oh, I like that one. Oh, but it's lower down the list. Oh, pity. Oh dear. Okay. Okay. A funny one. Black Circle says, give us some good news. There's lots of good news. Earnings season was great. 9% earnings growth. Good, right? Funding costs, very low. Even now. Credit spreads are increasing. Yields are increasing, but still by historic standards, funding costs are low. What else? Valuations are lower than they were 6 months ago. That's good. And what else is good? Yeah, if you look at 5-year forwards, so let's have a look at 5-year inflation right now. And I'm going to show you that from Fred, my favorite website. And I've got to remember to share my screen. Here we go. So this is 5-year inflation. Look, it peaked. People were expecting inflation. So this is looking at inflation expectations from the market, but 5 years ahead of where we are today, and then looking 5 years out from there. So what will 5-year inflation be 5 years from now? Now, until recently, that thing was shooting up, right? Markets were thinking the Fed was out of control. It had lost control of inflation, and it was just moving up and up and up until April, when it suddenly turned around, right? It looked like the Fed was back in control, according to markets. And the peak of that was April the 21st. So it's almost exactly a month ago. And currently that's, down to 2.34, which isn't too far above the Fed's 2% target. So, that's another good piece of news. The market thinks that the Fed's in control of inflation, or at least more so than it was in April. So, there's lots of reason to be positive right now. It's easy to get caught up in the kind of negative news stories, but, the jobs market is very strong. Okay. So if you want to find a job, it's really easy. And, that's good. So those are the good bits of news. We all think about the bad stuff, but the good stuff's important to appreciate as well. Oh, and the other good thing, returns over the last decade have been incredible. And that's true even after the falls this year. So, always count the positive things as well. Right, next question. Lovely to see Teddy, Lynn says. He's fast asleep now, okay. Happy bank holiday from Ben Beach. That would be nice. But thank you. Oh, interesting. Lukasz Chef Shoes. SZEWC. I'm guessing that's Shoes or Shoes. He says, quantitative tightening and reverse repo. Are these two concepts related? Oh, I like that. Well, I mean, obviously, I just made a video about reverse repo. It's a little bit of a nerdy topic, but it seems really popular. The stats are just so good for it for us because somebody posted, they actually had a link to one of our posts about reverse repo on Reddit. So if you are on Reddit, why not link to our latest one? I'd appreciate it. But, okay, that was a dodgy thing to say. But I think what's really driven reverse repo, firstly, the counterparties are 80% or 90% money market funds. So that's who's doing reverse repo. Why are they doing it? To get their hands on treasuries. Why do they want treasuries? Because that's what they're allowed to buy. And with reverse repo, you get pretty good yields with it relative to other investments at the moment. So if you look at some of the largest money market funds in the world, particularly in the US right now, they're doing a lot of repo because, it's reverse repo for the Fed, it's repo for the money market fund, where they take their cash from their investors, they hand it over to the Fed, and the Fed gives them treasuries. And that's what's pushed it over 2 trillion. It's primarily money market funds because there's a shortage of treasuries, less short-dated debt out there. US treasuries essentially squeeze the supply. Why? Because they want to lock in low interest rates. So they're issuing more long-term debt and less short-term debt because the short-term stuff's going to roll over and pick up the higher yields and increase funding costs for the US. So, all of this stuff is rational. Each of the players is doing a rational thing. Money market funds want yield on treasuries and they want to get treasuries. The Fed wants to make sure markets are stable. They have an unlimited balance sheet, so they're quite willing to take their treasuries, which are on their balance sheet, and lend them out. And so all of it is rational, but it looks like it's out of whack. So it's all happening for reasonable, for kind of rational reasons, but it's got a lot of people spooked. But that's, I think, the primary driver of reverse repo. That's what's pushed it over 2 trillion. And quantitative tightening, well, the problem now is that a lot of that short-term debt, which is on the Fed's balance sheet, is going to roll off. So the Fed's not going to have so much stuff to lend out. Maybe that's going to be a problem. So, but that still isn't a problem yet. Quantitative tightening creates a demand for safe stuff because it's caused equity markets to sell off, scared people. They want to park their money somewhere safe. So you take it out of equity and you park it in the safest thing possible, which is a money market fund. Then the money market fund needs treasuries. Where do they get them from? Repo with the Fed. Yeah. So that's what's driven the reverse repo. A lot of it, fear. And if the fear subsides, the reverse repo will subside. So, as soon as the shock of quantitative tightening eases away, which it usually does, I expect the fear will subside and the reverse repo usage will also subside. That's what I'd expect. Okay, one more question. Let's just check whether members have asked one. No, they haven't. Okay, so it's going to be one of the other people. Okay, regards from Abu Dhabi Airport. Hi, Rajiv. Okay, nice to hear from you. Diversifying in a stagflationary environment. Yeah, gold is probably the best thing. Cash is clearly not going to work, and because it's high inflation, gold is probably the best thing. Energy companies would be another thing. If what's driving inflation is energy, which is still I think true, then buying those companies will be a hedge. Okay, but other than that, it's really hard to allocate in a stagflationary environment. So there isn't any easy hedge out there. So have we got time for one more? One more. Okay. Finally, okay, so Matthew Thomason says, do governments want high inflation to reduce their debt burden? No. If you have the kind of inflation which is really high, it creates so many problems for the economy. I mean, we can all see that now. Yes, it will erode the government's debt, but if it causes a recession, which is likely, you can see growth weakening, then that reduces the government's tax receipts. So generally, it's not good for the government overall. Does it inflate away the debt? No, not necessarily, because it causes so much economic pain and it reduces future revenues during the kind of weak economic period. So, as a kind of debt removal strategy, it's atrocious. The best way to remove, or at least to kind of make the debt less relevant, is to grow your way out of it. Have high growth, and that means fiscal stimulus. Yeah. So fiscal stimulus, infrastructure spending, that's usually how governments get around it. And usually you'd have higher growth, which makes the debt to GDP ratio diminish. That's how we've successfully got rid of debt in the past. Yeah. So anyway, 1 minute past 8, that's it. Thank you for spending the hour with us. We appreciate it. Don't forget, if you want to become a member, PensionCraft.com. If you want a power hour with me also, look at PensionCraft.com under the coaching section. And don't forget to like and subscribe. And thank you for your support. We really appreciate it. And we hope you have a great month. And we'll speak to you again in a month's time. So take care, everyone. And goodbye.